Hey everyone, welcome back to Corporate Decoder, the place where I read the small print so you can see what the deal really means. And today we have a finance heavy 8K that mixes debt and warrants into one big move. And yes, we will break it down so you can see who wins, who loses, and what it can mean for the stock. If you like getting straight insights from corporate documents, make sure you are subscribed. And if you want to talk about this stuff live, we have a Discord community linked in the description below. Let us start with the headline. The company is raising money by selling units that include a loan and a warrant. And that is not your usual boring debt or equity combo. This is designed to give Sonder runway for its business while also giving investors a big upside if the stock takes off. And the structure also means big questions about control, dilution, and risk R note and warrant purchase agreement. Risk note and control dilution and risk R note and warrant purchase agreements come on August 5, 2025, Sonder Holdings Inc. We begin with the core agreement that sets up a pretty aggressive financing. The company is selling units worth about $24.54 million a time. When a company sells units, it usually mixes a loan and a promise to buy stock later. This one includes a senior secured promissory note and a warrant to buy common stock at a fixed price. This is a way to get cash now and also promise future equity if things go well. The investors in this deal are qualified buyers and some hold the company's preferred stock. This makes the deal more targeted at wealthier investors who are willing to take risk for big potential gains. Now, the big numbers, the investor notes pay 15% interest per year and the interest is paid in kind, which means it adds the principal rather than coming in cash every quarter. This creates a compound effect that makes the debt grow a bit faster, and there is a lot of risk here because if the company can't meet its targets, the notes can become expensive very quickly. The notes are secured by the company's assets and guaranteed by the company's domestic subsidiaries. This is a strong claim by lenders and it means they get paid before owners if things go wrong. The arrangement also puts the senior notes and rights in a hierarchy with other older debt than new investor notes, and the related liens rank senior to the 2021 notes, which could affect existing lenders and shareholders. This is a financing that gives the company a chance to push forward with its plans, while giving lenders a strong position if the company runs into trouble. The other big piece is that the company plans to use the proceeds for working capital and general corporate purposes, which is a broad way to say they want cash to run the business and invest in growth opportunities. The purchase agreement includes standard protections and covenants. The company cannot pile up more debt without checks, and there are limits on other risky moves. This is classic risk management for lenders to protect their position while the company tries to grow. The investor notes also include default events like missed payments, breaches of covenants, and even an event if the company fails to raise a minimum amount by a date, and if that happens, the lenders can accelerate the loan and push other remedies, which is a big lever that lenders hold. The deal also requires the company to seek stockholder approval for the issuance of shares that come from exercising the warrants and for increasing the number of authorized shares to fit that potential tranche. This is a big governance touch because it means the company needs backing from shareholders to actually issue the shares. If the stockholder approval is obtained, the warrants can be exercised for a long period until August 2029, and the cash price for those shares is set at $1.50 per share. The warrants will also adjust for events like stock dividends, stock splits, and similar corporate actions to protect investor value. The deal further includes a provision to limit a single investor and its affiliates from owning more than 4.99% of the company's common stock. But there is a path to raise that limit up to 99% with notice. This is a standard anti-dilution and anti-control clause that protects both sides. The lenders and the company also will file a registration statement to help the resale of warrant shares in a timely manner, which is important for investors to unlock liquidity if the warrants become valuable. The warrants themselves are a big piece of the puzzle, and they are collectively exercisable for a large chunk of common stock that creates real upside potential for investors if Sonder grows fast. This is a classic structure that blends debt with equity upside. The advance also includes an implication that a specific investor group called a covered investor gets a big right to participate in future equity offerings, which gives the investor a kind of priority in future rounds. This can be powerful and it can tilt future capital raises toward the investor group. This is a key moment because the company is weaving together not just the financing, but also governance and control pieces that could shape its strategy and the way it moves through the next year. Now I want to zoom in on the payments and what makes this deal expensive if you are lending money to a company with big growth ambitions, you want protection and you want to be paid back as soon as possible. This structure gives the lenders a chance to receive a nice return if Sonder does well, but it also puts heavy pressure on the company if growth slows. The lender notes are described as senior secured notes with a long name and a heavy set of protections. The notes mature in 2026 and they accrue interest at prime rate plus 3%, which is a high interest rate for a loan, and it is paid in kind monthly. So the company does not have to write big cash interest checks every month, at least not at first, which helps preserve cash, but the interest accumulates and compounds. The notes are guaranteed by the company's domestic subsidiaries and are secured by substantially all of the company's assets on a par passu basis with other senior debt. This means the lenders have a strong claim on assets and a fair shake in payments if there is trouble. The loan structure also interacts with a roll-up payment feature that is tied to the lender notes, and it is connected to the Third Amendment to a license agreement with Marriott, which is a big strategic partner for Sonder. This roll-up cashless mechanism is designed to reduce cash payments for certain amounts, but it shifts those obligations into the notes themselves, which increases the complexity and potential risk of the arrangement. And the purchase agreement also sets up covenants that will limit new indebtedness and asset sales and restricted payments, among other things. These rules are meant to keep the company from piling on debt that could jeopardize lenders. There are also standard default events, including cross defaults to other indebtedness and bankruptcy. This is all about giving lenders a path to protect themselves if things collapse. The financing also creates a path for a stockholder meeting to approve the big issuances, and it requires the company to file a preliminary proxy and a definitive proxy so that shareholders can vote on the Nasdaq proposal to issue warrant shares and on the authorized share proposal to issue warrant shares and on the authorized share proposal to increase the number of authorized shares. This is critical because without stockholder approval, the plan cannot go forward. The warrant shares have not been registered under the Securities Act, so they cannot be sold in the United States without registration. This is another protection that keeps some risk with the deal while the company hopes to register the shares. The financing package also includes a voting support agreement in which a majority of the company's voting stock promise to vote in favor of the Nasdaq proposal and the authorized share proposal. This is a behind-the-scenes way to align major shareholders with the financing plan. A key point is that the company needs to raise at least $32.5 million from capital sources by November 15, 2025. This is a milestone that can unlock more financing and keep the plan alive if they miss at the default, and consequences could intensify. The overall package also includes a loan arrangement with Marriott International to replace certain fees owed to Marriott under a license agreement. This roll-up is designed to create more cash flexibility for Sonder while also tying it to a key partner. The company also entered a Seventh Amendment to the Note and Warrant Purchase Agreement, which provides waivers in connection with the closing of the transactions and modifies covenants under the 2021 Note Purchase Agreement. This is a signal that the company is negotiating a lot of moving parts at once. This exact line captures the scale of the equity upside embedded in this deal, and it helps you picture how much stock could change hands if the warrants are exercised. This is a powerful lever for investors and a big potential dilution for existing holders if all the warrants are exercised, which is not guaranteed but possible. This is a safety net for investors and a reminder that the deal tries to protect the value of the warrants even if the company does things like issue more stock or experience stock splits. This kind of feature keeps the investor upside more predictable. This line tells you when the debt becomes due, and the calendar is tight. The 1-year cadence here means Sonder has to be disciplined about cash flow and refinancing if needed because the notes could come due just as the company is trying to scale. This is the change that plugs into the Marriott deal and hands the company some runway with a cashless structure while also creating more obligations to keep the relationship with Marriott. Healthy, this is a classic case of a growth plan being tied to a big partner. This is the change that helps all the pieces fit together. A consent and a Seventh Amendment suggest they are adjusting the rules to get the financing done. This kind of adjustment is common in fast growth companies trying to assemble a complex capital stack. Here is the practical side. The money goes to keep the business moving, to pay people to stock up inventory, to invest in growth, and to fund day-to-day needs in plain speak. This is money for the daily grind of growing a company, not just for fancy projects. As we connect these dots, the big picture starts to form. Sonder is stitching together a big debt line, a large equity upside through warrants, and a strategic deal with Marriott, all while trying to win shareholder support to issue more stock and keep the lights on. From a financial health point of view, this looks like a high risk, high reward setup, the 15% interest on the notes. And the fact that the notes are senior secured and tied to a license arrangement means if things go wrong, the lenders will be paid first. The company's ability to raise a minimum amount by a set date becomes a critical trigger that could tilt the entire deal. If you are thinking like Warren Buffett, you would watch two things very carefully: the price you pay for a future stream of profits and the reliability of the business. To generate cash there is some degree of confidence in Sonder, because the assets are backed and there is a plan to grow through partnerships, but there is also a big caveat: the cost of capital is high and the debt burden grows with the money they raise. The poker face here is strong. The real question is, can they grow fast enough to justify the cost? A quick note on the stock side: this plan relies on a public stockholder vote to issue the warrants and to raise the authorized share count. This is not a done deal yet. If the Nasdaq proposal or the authorized share proposal fails, the whole thing could stall and the warrants could lose value or be less attractive to investors. This is why shareholder support matters a lot here. The company's bigger strategy is to use capital to accelerate growth, get closer to customers, and build a stronger platform around its properties. This means more funding, more partnerships, and more options to use the cash to create value, but it also means more risk if the business environment slows or if execution lags. In the outside world, Sonder operates in a crowded field with other hospitality tech players and real estate-backed models. This kind of financing helps it stretch its runway, but it also invites scrutiny from investors who want to see measurable progress on revenue growth, cash burn, and profitability. The market wants to know that the company can generate positive cash flow eventually, and not just chase growth for growth's sake. Now, looking at the numbers, in plain terms, you are not just reading about a loan, you are watching a move to shift more risk onto the company in exchange for a chance of big upside. If the warrants become valuable and if the stock price climbs, the plan tries to balance short-term cash needs with long-term equity upside. There is a strong lead in the Nvidia, like fast growth world of tech and hospitality, where the timing of capital raises is everything. If the company can pull this off and get shareholder approvals, it could gain the speed it needs to push forward. However, if the market turns or if the company can't hit the targets, the cost of this debt and the risk of dilution could bite back, and shareholders may not feel like they won. From a storytelling standpoint, this filing is telling a fairly classic startup style tale. The company needs money to grow. It lines up with a powerful investor base and it arms the business with a substantial equity kicker. If things go well, you get a big upside. If they struggle, the debt and the liens protect lenders and the dilution hits shareholders, making it a high stakes move. The management team will have to navigate the balance between debt and growth, and the board will need to keep a steady hand on the future cash needs as they pursue the Nasdaq proposal and the authorized share proposal. The timing is tight and the milestones are clear. They must raise a certain amount by mid-November to keep the plan alive and avoid more costly negotiations. In conclusion, this filing shows a bold and aggressive capital plan that mixes debt and equity upside. The debt terms are steep, the security structure is strong, and the potential upside for investors is meaningful. But the risk to the company's cash flow and to current shareholders is real. This is a turning point for Sonder. It could unlock fast growth if the money is used well and the stockholder votes go in their favor. But if things go wrong, the costs could be high and the rewards could slip away. With every quarterly report, the world will watch to see if this big bet pays off. Before we sign off, a quick note for investors and curious minds. The idea here is to buy time to grow and to do it with a safety net of assets, yet the cost of capital is high, and that means the company will need strong execution and a friendly market to keep the plan alive. If you want to dive deeper together in the comments, tell me what you think about this money mix. Would you bet on the warrants to pay off the upside, or is the debt load too heavy? And do you think the stockholder approval process will go through? And how much dilution would you tolerate? As always, I want to remind you to join the Discord in the video description so you can talk with me and other viewers about this deal in real time while the stock market moves. Alright, this is the end of our breakdown for today, and I want to give you my take on the company. As we see it, Sonder is pursuing a bold path with a big leverage plan. The upside is clear if the business scales well and if shareholders embrace the dilution, but the risks are real. The company's ability to hit the milestone fundraise by November 2025 and to manage the debt load will shape its path for the next year and beyond. In terms of strengths, Sonder has a strong strategic partner in Marriott, which could unlock valuable opportunities, and the capital has the potential to accelerate growth. Across its platform, this kind of alliance can create network effects and improve occupancy and pricing power in a competitive market. On the weakness side, the cost of capital is harsh and the structure puts a heavy burden on the company. If growth stalls, this could lead to higher financing costs and tighter liquidity. This is a classic risk you only see in fast-growing tech-heavy businesses. Notable risks include the requirement to raise a minimum amount by a given date, the complex web of covenants and liens, the possibility of significant dilution, the dependence on shareholder approvals, and the potential for a negative macro environment to squeeze cash flows. Notable opportunities include leveraging the capital to expand growth in new markets, building a stronger portfolio of assets, and deepening the partnership with Marriott, which could bring benefits beyond a single loan. This is a story of using leverage to fuel growth. If the company can execute well, it could, plus the upside is meaningful if the warrants become valuable and investors gain confidence. In a word, the deal is a big leap forward with major potential and real risk. This is the kind of move that can change a company's trajectory. The final outcome will depend on execution, investor appetite, and the broader market. This is a story worth watching, and we will continue to follow the numbers and the votes so you know how it turns out. If you enjoyed this breakdown, please hit the like button and subscribe for more deep dives into corporate filings and complex finance moves, and I want you to be part of the conversation, so join the Discord in the description and share your thoughts with the community. Thanks for watching, and I will see you in the next video.